In this video, I'm going to focus on the income side of the debt-to-income ratio that lenders use to qualify you for a loan. It's a pretty big topic, and this is part 3 in a playlist of 6 videos. Check out all the videos to learn more, and if you have a chance, take a moment to like and subscribe to my channel. I'd appreciate knowing that you found some of this information helpful. Now, truly, your debt-to-income ratio couldn't be more important. It is how lenders decide how much you'll be approved to borrow, and it can even impact some of your loan costs. Your debt-to-income ratio is calculated by dividing your monthly debts by your monthly income, and in part 2, I took a deep dive into the debt side of the equation, what counts as debt, and a few loopholes. So next and now, we're going to dig into income, starting with some background concepts that will, I hope, help make sense of some of the details that are going to follow. Now, one thing to know is that lenders use your gross or pre-tax income when figuring your debt-to-income ratio. How much you contribute to your 401k, pay towards benefits, pay in income taxes has no impact on your qualifying income for a loan. And this may sound a little crazy because the money that goes into retirement and taxes isn't available to pay a mortgage or anything else for that matter. And this is one of the many reasons that you don't want to rely on a lender like me to tell you how much you can afford to borrow or what you should spend. I'm really good at showing you what's possible under loan rules, but lenders aren't financial planners and we're not trained to help with budgeting. I also think it's helpful to think of all the conversations you have with a lender as taking place in a parallel universe with its own rules. If you can mentally put air quotes around the word income in the lending process, you may save yourself some frustration. My clients will often hear me talk about qualifying income, or for a few programs, eligibility income. And these modifiers are a good hint that we're moving outside of the real world and we're not talking about what you actually earn, what you live on, what you use to buy groceries and pay the bills. We're going through the looking glass into the parallel universe of Lenderland. And in Lenderland, we have our own logic and rules and require documentation that we'll use to figure your income in ways that may not feel right or align with what you know you earn and what you know you can pay. And as I talk through the details that follow, if you keep this in mind, and, I guess keep it in mind if you run into this frustrating experience of being told that your debt-to-income ratio is creating issues in qualifying for a loan that you know you can afford. If this is happening, start asking questions. Your lender should be willing and able and eager to help you understand what the rules and documentation requirements are for the loan you want, and then work with you to fit your income into those rules. My team and I put a ton of effort into understanding our clients' financial worlds so that we can then collaborate and make things work, kind of shave the corners off of square pegs and coax them into the round holes of lending rules. It's a lot of what we do on a daily basis. So let's talk about some of these rules and a few examples. And for starters, I think it's good to understand a couple of tests that all income used to qualify for a mortgage has to pass. It has to be stable and have what lenders call continuance. So let's talk about continuance first. To count in lending, your income has to appear likely to your lender to continue for 3 years after your loan closes. This doesn't mean you need to have a guarantee it will continue. In the absence of any information showing a source of income is going to end within 3 years, we're happy to assume it will continue. So what we don't want, what causes issues, is any evidence a source of income may end within 3 years. And there are times when the nature of your employment may imply a lack of continuance. If you work through a temporary agency or as a contractor, you'll probably have to show evidence your current assignment is open-ended, or at least that it doesn't have a set ending date inside of 3 years. Or if it does, that it reboots or reschedules or re-ups in some way. And please don't leave your current job prior to closing on your loan. Income from a job you're leaving can't count toward a loan. And if you have a history of receiving bonuses or working overtime, your lender's generally going to ask your employer. We send a form called a verification of employment form. We'll be asking them with this form to confirm that your bonus and OT is likely to continue. And if you work in tech and you receive restricted stock units as part of your pay, lending rules are going to be aggravatingly out of step with the times. Logically, RSUs really should be treated just like a periodic bonus, but most loan programs don't treat them like a bonus, and they often require documentation that doesn't align with real-world grant investing schedules. So if a significant amount of your pay comes from RSUs, it is super important to get an early start working with a lender that understands RSUs. You're welcome to call me at any time. And continuance rules apply to all kinds of income. If you're drawing income from assets, for example, from a retirement account or a trust, the account balance has to be sufficient to support 3 more years at the same level of income after your loan closes. If you receive income from an annuity or long-term disability, same thing. You'll need to provide proof that you've got another 3 years of payments coming post-closing. Now, continuance for investment income, like dividends, interest, or capital gains, is established just by showing that the assets generating the income will still be around after you close. Liquidating investments to fund your down payment could reduce or maybe eliminate some of the investment income from loan qualifying. Social Security, pension, Social Security disability are all generally assumed to continue for 3 or more years, but short-term disability won't typically pass a 3-year continuance test. And continuance is a really important topic for child support or alimony income. Lenders will only count the lowest amount of income that you're scheduled to receive 3 years after closing. So if your alimony payments step down over time, or if you're receiving support for a 16-year-old that's going to end when she turns 18, some or maybe all of your support may not count for loan qualification. If you receive support payments, I would encourage you to check out this video. It goes over everything you need to know about using support payments to buy a home. And if you're low-key stressing out listening to all of this continuance talk because you're a freelancer, a contractor, or a traveling nurse, don't worry. Even though individual gigs, when you work in this style, won't likely ever pass a 3-year continuance test, you can still get a mortgage. You just need a lender willing to help the underwriter understand the nature of your work. Once you explain how you work, a lender should be able to pan back to the big picture and use your history of rustling up new work, new gigs, as evidence that you're likely to continue finding more new work in the future. And as a personal aside, I want to say I love working with freelancers. I regularly help traveling nurses and creatives in design and film and TV and media and project management and coding and more secure mortgages. And this topic hits extra close to home for me as I'm married to a freelance designer. So if you're a freelancer and have lending questions, we should talk. So now let's talk about that second income test, which is stability. A lot of income is self-evidently stable. If you're on a salary or you have set hours or you're scheduled for a certain number of hours at a certain rate of pay, your income is probably just good to go. And that's true even if you got a raise recently or recently changed jobs. In fact, you can even buy a house up to 90 days before you start a new job if that new job has a set salary. When assessing stability, underwriters look at your pay stubs and not your schedule. And this can become really important if you're scheduled to work for 40 hours a week, but sometimes you knock off early or maybe some of your vacation or sick days aren't paid. Stability can wind up being called into question if your pay stubs don't match that schedule that you're supposed to work, or if your history of earnings is a little short of what it should be if you were working 40 hours a week. So if you're planning ahead for a home purchase, keep your hours as steady and consistent as you can. Other income sources that have self-evident stability include anything paid to you in a set amount at a regular interval. This would include pensions and annuities, Social Security, or regular recurring distributions from a trust, from an IRA, or from a 401k. Those all fall into this category. And setting up regular distributions from a retirement account or a trust account can be a good stable source of income, especially if you have a history that's less stable, maybe taking what you need when you need it. But what about other sources of income that are just naturally variable in nature? Well, income that fluctuates can, of course, still be used for your loan. We just have to figure out what your income is going to be, and we do that by averaging it over time. When we average variable income, the gold standard is to average it over 2 years. But exceptions allowing an average of between 1 and 2 years are not uncommon. They're quite common, in fact. But if a source of income is variable in nature and you've been receiving it for less than a year, it probably isn't going to be part of your loan qualifying income. Now, variable income can be a portion of your income. That would be true for bonuses, overtime, commissions, restricted stock units, or there are instances when your entire job may have variable hours or variable rates of pay. Nurses and flight attendants are good examples. They often have both variable hours and variable rates of pay that will just be averaging over at least 1, but ideally 2 years. And my creatives, traveling RNs, and other freelancers will be averaging your income over time to get a sense of what your stable income looks like. And you might be surprised to know that we can even count unemployment compensation toward your income for a loan under certain circumstances. We just have to show it's a regular part of your income, which is often the case for skilled union members in the trades. And income from self-employment is kind of a big topic, but where it fits in here is that it is always considered variable. And a technical note, if you own 25% of a business for which you work, you are considered self-employed. 24.99% and you're an employee, but 25% or more and you're self-employed. And also, any job where your employer doesn't withhold taxes, if you're paid on a 1099 and not a W-2, you're considered self-employed. And that would include gig work for Lyft or Uber or DoorDash. Income from self-employment is calculated using your most recent year or two of filed income tax returns. And if your business has grown rapidly and profits are up this year compared to your last year or two of filed taxes, this can feel pretty frustrating as looking backwards isn't going to capture your real income today. And another factor to keep in mind when you're self-employed is that lenders look at net self-employment income, and that's after you write off business expenses. The harder you work with your accountant to lower your tax bill, the lower your mortgage qualifying income is going to be. There are a few really key nuances to understand about this and share with your tax preparer, and I put together a video you can watch here to learn a handful of important tax tips that you can use to minimize your tax bill without reducing your income that you can use for qualifying for a loan. And if you're self-employed and you're struggling with loan qualification, don't take no for an answer. Get a second opinion. I can't count how many times I've gotten calls from self-employed folks having trouble qualifying for a loan, and my team and I were able to figure something out. If traditional lending rules in your business don't play nicely together, there are all kinds of creative options. There are loan programs that allow alternative means of documenting your income using cash flow through your bank statements, or maybe preparing a profit and loss statement with accurate current income on it. Now, shifting gears, we develop stability for investment income, dividends, interest, and capital gains by averaging it over 1 or 2, or in the case of capital gains, sometimes 3 years. And the same thing will be true for income from IRAs, 401ks, or trust distributions that aren't on a regular set schedule. And next, I want to talk about a few special cases. If you're paid hourly and your rate of pay has increased a lot over the last couple years, this tendency in lending to average your income can wind up shortchanging your earnings. And if this is the case, it can really make sense to average your hours worked instead of your earnings. Averaging your hours worked and then applying those average hours to your current rate of pay can give a much better representation of your current income. This will commonly be the case if you're part of a union and you've received contractual increases to your hourly rate, especially if you're working through an apprenticeship and you're getting those really big bumps in pay as you work toward being a journeyman electrician and, something along that line. This really can be the best strategy. And if any of your income is untaxed, your lender can usually count it at higher than face value. Social Security benefits, disability income, child support, VA benefits, investments, Roth IRA distributions, these are all generally not subject to income tax. And when tax isn't due and you get to put more money into your pocket, lenders can generally do what we call grossing up this income. We can gross it up and count it at 115 to 125% of face value. So $1,000 of untaxed child support could count as $1,250 of income for loan qualifying. And rental income is a big special case in that it can be part of your debt, part of your income, or neither. And there are a lot of if-thens to figuring how much rent we can count and what to do with it. We're really we're running a little side calculation, and we're aiming to figure out your cash flow. So for each rental property that you own, we calculate the rent net of expenses and then deduct the mortgage payment. And for purposes of this calculation, when I say mortgage payment, I'm including the loan payment, taxes, insurance, any mortgage insurance, and any homeowners association dues. If net rent minus the total mortgage payment is a negative number, we add it to your debt in your debt to income ratio. As far as your DTI is concerned, a cash flow negative rental has the same impact that a car payment would, let's say. If net rent minus the mortgage payment is a positive number, we can at least zero out your mortgage payment. That neutralizes it so that the mortgage and taxes and insurance for that property aren't part of your DTI at all. And if your tax returns show a couple of years of experience of history managing rentals, then we can usually add positive rental cash flow to your qualifying income. How we'll calculate the net rental income to plug into one side of the equation or the other really depends on how long you've owned the property. For a property that you already own, but acquired or rented out recently enough that it doesn't show up on your most recent year of income tax returns, we'll ask you for a copy of the lease. We will then deduct 25% from the rent you charge and then subtract the total mortgage payment. That 25% deduction is what we call a vacancy factor, which is kind of a stand-in for actual vacancy, but also operating expenses. If you don't have a lease, let's say you bought a short-term rental earlier this year, then the full mortgage expense, taxes, and insurance, and any HOA dues will be included as part of your debt. If short-term rentals are creating issues with loan qualifying, and they really can, a little brainstorming about alternative loan options could be in order. There are some good alternatives that can allow you to pull short-term rent in before it shows up on your income tax return. Now, for a property you've owned long enough to show up on your tax returns, we'll calculate the net rental income with the information on your tax return, on Schedule E of your most recent year or two of taxes. If you own a property in a partnership, then we'll go to Form 8825. It looks just like Schedule E, it's just on that partnership return. And this calculation that I'm going to talk through feels a little bit of a two-step forward, two-step back, weird do-si-do of a dance move, but I'll try to explain the logic behind what we're doing. For each property individually, we start with the net income or loss after all the expenses that you report to the IRS on Schedule E. Then we add back a few things that fall into two categories. The first are non-cash flow expenses. The IRS allows a write-off for depreciation and amortization, and these are paper expenses, not something for which you wrote a check. These paper write-offs are actually one of the bigger tax perks for real estate investors. Now, the second category of expenses we add back are all the things included in your total mortgage payment. Property taxes, mortgage insurance, mortgage interest, homeowners association dues, all of those expenses that are part of what we would call your PITI. Now, this is the weird dance step that we do. We're going to add back these historic expenses because we're then going to subtract the current mortgage payment. And that again includes the mortgage interest and any mortgage insurance and property taxes and homeowners association dues. We're going to subtract that from the net rental income. And we don't want to double dip and count these things twice. So after we've made these adjustments, we take the resulting figure and we divide it by 12, and then we subtract your current mortgage, taxes, insurance, and HOA dues. When your new loan is for the purchase of a new investment property, we do things just a little differently. We get a copy of any current leases in place, and then we ask the appraiser to prepare a rent survey. The appraiser finds nearby similar rental properties and uses them to estimate market rents for us. Most of the time, we'll deduct a 25% vacancy factor from the appraiser's estimate of market rents and then subtract the loan payment to determine cash flow. But there is an exception to this. If the current lease in place is at a below market rent and the lease and/or local lending rules won't allow rents to be increased within a fairly short period of time, the underwriter may decide to use the more conservative actual rent amount as the starting point for their calculation, then deducting 25% and deducting the mortgage payment. And before I wrap things up talking about rental income, I want to mention 3 more special cases. What lenders call border income, income generated from renting an ADU, and income from other units in an owner-occupied multifamily property. If you're a house hacker and you plan on offsetting your mortgage costs to keep your overhead low, one or more of these categories of income is likely to be part of your plan, actually. Now, border income is what lenders call rent from roommates, family members, or other folks who are going to be living with you but won't be on the loan with you. Most loan programs simply don't allow rent from roommates to count toward loan qualifying, but there are a few exceptions. Now, the most common exceptions in loan guidelines are some of the least common in the real world. Rent from a live-in healthcare aid is permitted under most loan guidelines, but is very unusual to see. Also, FHA allows border income, but only if you claim the income on your income tax returns and your boarders, your housemates, are related to you by blood, marriage, or law. And I haven't yet met anybody who gets rent from a family member that they also claim with the IRS. Now, Fannie Mae and Freddie Mac have some more practically useful rules. They allow rent from roommates as up to 30% of your loan qualifying income under a couple of their affordable lending programs. To be eligible, your total qualifying income, and that includes the rent that you're receiving from your boarders and adding to your income, can't be more than 80% of the median income for the area in which you're buying. You also have to prove a year of cohabitation with your the boarder, your housemate, and document that they've paid at least 9 months of rent to you during that year. And that has to be paid directly to you. So if you and your housemate split rent and your housemate pays your landlord, that's not paid to you, so that wouldn't count toward that 9 months of rent they have to show received by you. If you check these boxes, then the average of the rent you've documented that your boarder pays to you over the most recent 12 months can give your qualifying income a bit of a boost. Now, accessory dwelling units, ADUs, are becoming more and more common, and thankfully, it's been a long time coming, but loan guidelines are really evolving pretty rapidly to include rent from ADUs. As I record this, Freddie Mac has the most liberal rules. They pretty much allow rent from an ADU to be treated just like rent from another unit in a multifamily property. And if you're buying a home with an ADU, or you're buying a 2, 3, or 4 unit property and you plan to live in one unit, your lender is going to order a rent survey as part of your appraisal, and 75% of the appraiser's estimate of the market rent from the other units or the ADU can be added to your loan qualifying income. If you've lived in a multifamily property long enough that rental income and expenses are included on your latest tax filing, then we'll just analyze your tax returns the same way we would for any other rental property, with one key difference. Once we add back the depreciation, amortization, taxes, insurance, and so on, we simply add the resulting number to your income. Now, if you're thinking all of this sounds like a lot, you're not wrong. Gathering the necessary information and documentation and using it to calculate income according to all of these rules is truthfully a lot of what fills the day for a lender. It certainly does for me and my team. But once we have your income and your debts figured out, our work isn't done. We've got to take all this information and move on to the next step, which is to figure out what loan program is your best option and how much you can qualify to borrow. And that's the topic of the next 2 videos. So follow along and I'll see you in the next video.